Welcome everybody. Welcome to my channel, Financial Trader's Mindset. So you want to make some money. You want to buy the dip, sell the rip without doing too much work, right? You're looking at DeFi and you're just like, how can I save as much time as possible? How can I put the least amount of time as possible into DeFi to extract the yield out of the market, right? How can I get returns without putting in too much work, right? Because I say day in, day out, one of my main messages is that most people should not be actively trading markets, right? Simply because too much emotion involved, there's strategy, you have to put in a lot of work to actively trade, right? So for 99% of the people, they just want to invest. They just want to invest. They just want to make money. They don't care about timing the market, right? They just want to use time in the markets to generate returns, right? So in this video, I'm going to show you how to do that, leveraging the power of DeFi, using concentrated liquidity pools like on Uniswap V3. So let's get started here. So what you see here on my screen is a position. Now I'm going to walk through a position here that I currently have going on and just showing you opportunities on where you can use concentrated liquidity to buy the dip and sell the rips, right? So here you go. You got a position here. This is an Ethereum USDC position with a range, liquidity pool range of 1800 to 3505. So that's the price range of the liquidity pool. Now, what I want to do in this scenario is I want to either accumulate more Ethereum if price goes lower from here. At the time, the price was 2372. So if price went down towards 1800, I would buy more Ethereum. And then if price were to go up towards 3505, I would be selling more Ethereum on the way up. I would be selling my position, right? So in a way, it automates the buying and selling of your position. Now, not to mention, during this whole time, you're earning yield every time a transaction is made on this liquidity pool. So you earn money while you wait for your position to fill, whether it's accumulating or distributing. You can apply this logic into DeFi with concentrated liquidity. So what I want to show here is that I set up this liquidity pool range. Now I'm going to show the next step. I staked this on May 18th, right? May 18th, I staked $46,557 of liquidity into this liquidity pool. Now fast forward to June 12th, when price went from 2,300 and some change, now at 2754 on this date. Now you can see the liquidity pool value has increased from 46,000 and change to 50,000, right? So I made a gain, a capital gains, and this took about 3 weeks, right? I staked this on May 18th. On June 12th, I'm here about to manage it. So it took 3 weeks. I did nothing in that during that time frame. In those 3 weeks, I did nothing. I just let the market oscillate in between my ranges. It stayed 100% in range, and I earned yields. Right, you can see here I earned $1,127 in yield, and I earned almost $4,000 in capital gains. Right, pretty nice return. So the reason why I'm managing it here is because I think that the market's a little overheated at this moment, just short term. Right, I'm bullish Ethereum, but I want to take some profits. I want to pay myself a little bit of profit for taking on the risk. Right, at the time. So what am I going to do here? So I'm going to unstake this. Right, I unstaked it. And then I restaked it right over here. So I took some profit off the table, probably like a few $100s, right? And what I did is I set up a similar range, right? I paid myself a little bit, but I still kept the majority of the liquidity in the liquidity pool. Similar range, restaked. I went over and bridged over to a different network, but I'm not going to go into that. All right, so 49,650. So then what happened next? What happened next is on June 23rd, the price of Ethereum went from 2750 down to 2241, as you see here in the screenshot. This might drum up emotions within some of you, different types of reactions and emotions. Some of you are probably looking at it like, oh, okay, he bought the dip. That's what he was trying to do, which I was. And for some, you look at it and you're like, oh my God, you lost $5,000, right? You lost almost $5,000. Why would you do that? Like, I wouldn't want to be in this investment. All right. So that's why it's very important to have a plan. You plan out what you want. And what I wanted to do is, I didn't care if I was buying Ethereum on the way down. That's why I set up this liquidity pool. So that's what it did. It buys Ethereum on the way down when price is going down, and I accumulate more ETH, right? So that's fine. And, it just comes with the territory. You're buying the dip. And as the dip keeps going lower, the value of your position goes lower, right? That's the way it works, right? So I wanted to buy more Ethereum, and which I did. And at 2241, I'm looking at this position. I'm like, okay, I think I have enough here. I want to reduce the frequency of how I buy, of how much I buy if price were to go lower from here. right? So watch what I do here. So I unstake it, and then I restake it into two separate liquidity pools. So I split the liquidity between the two. In this one, I staked $39,150 at a range of 1,800 to almost 5,000, right? Before, the upper range was 3,505. So what this does is that now I can hold more Ethereum if price were to go back up. And I'll show you in a second what that did, right? Because price has went up since then. And then the rest of the liquidity, I set it up in a lower or a USDT heavy or 100% USDT liquidity pool below the price of 2260, right? So if price went below 2262, I would be in range. And you can see the lower end of my range is 1,049. What that does is that, remember what I said earlier, I wanted to reduce the frequency of how aggressive I buy Ethereum on the way down. So going with a wide range to the lower end slows down that frequency. You can see here where I do not mention anything about yield. I don't mention like, oh, well, it's not going to earn this much yield and blah, blah, blah. Well, you have to think that yields don't get realized until over the course of a year. So if you're looking at this, you're like, oh, it's only a 50% APR. I want to get 100% APR. Well, if you want an extra 50% APR, you're going to have to go tighter in range. And that might not be the type of risk you want to put on into the market, right? Short term. You want to always think about risk and positioning. Forget about the yields, right? How much of the asset do you want to buy? How aggressive you want to buy it? What price range you want to buy it? And then you set up your ranges that way. So I have two liquidity pools running. Then we go up here to the present. Actually, I'll show my actual quick swap position. So we're right here, and this is my current position. Remember, I posited $39,150. It is now worth $41,560. And over that course of time, I've earned $110 worth of yield. And the lower end of the range didn't earn much, only $1, because now it's out of range, and that's the lower end of the range. That's where I want to buy more Ethereum, right? I don't want to buy more up here. I want to buy more below that 2262 price, right? So now Ethereum is in my upper range. It's selling, but it's selling a lot slower. Now the combined total, if you look at this, 41,560 plus 6211 in liquidity, 47, almost $48,000. I've recaptured the capital gains that I lost on the way down. And we're only at 2439. Now, if we go back and look at it here, we're at 49,650. That's when I started it, when price was at 2756. Price right now is 2439, and the value of my liquidity pool is about 48,000. How much Ethereum do I have in here? I have 11.57 Ethereum. If price were to go up another $100 to about 2550, the value of my liquidity pool will be about break even from when I started, when price was at 2750. That's a reduction of cost basis, nearly 200 points on Ethereum. And that's simply by just widen out the top of the end of the range when we're at 2250. Now, you're probably looking at it like, okay, that's great, but I can't time the market. Nowhere in here did I pull up a chart. Nowhere in here did I do technical analysis. I just looked at the market and I said, you know what? I think I have enough Ethereum. So what I'm going to do is I'm going to unstake it. I want to sell it higher. And also, if I'm going to buy more, I want to buy it slower if price keeps going down. So that's what I did. That's why I set up these two ranges. Okay. So you're looking at this, you're like, okay, that's great. How do I do this? Okay. I use Metrix Finance. You could go to the link in the description. I have a 30-day free trial you can use. You can test it out. But this is one of my main tools right here. What I did, popped in quick swap because that's where I'm on, the network I'm on, Polygon, USDT, Ethereum. So I click simulate, and it brings up this page. On this pair. And you can see here, you can find out exactly where to set your ranges, what the value will be at certain price points, and you can determine, okay, that's a range I want to set, right? So let's say, let's put like 48, what was it, 49,000 in here, 49,000, right? I don't care about the yield right now. I want to set the ranges, right? So initially it was like 1,800 to 3,505, right? There you go. I just match the ticks, and then it gives you the liquidity value, right? Oh, this price was about 37.50, right? So custom price, 27.50, 27.56. Okay, great. This was my liquidity distribution. 53% of it I owned of Ethereum. 46% of the pool was in USDT. As price comes down, so I'm like, okay, well, what will be the liquidity distribution as price oscillates in my range and at what specific prices? So we look here at the by token. So I'm like, okay, how much Ethereum would I own at like 2,200, right? 2,250, about 13.54 Ethereum. Okay, that's good. I kind of like that, right? You're looking at it, okay, that's not too aggressive. I kind of like the frequency it's buying down here. apply it to your own logic, right? I'm just kind of walking through here how to think about it. You're like, okay, price is going down. If you're like, oh, wait, that's too aggressive. If it's too aggressive, you need to widen out the range a little bit, fine tune, go back up here, adjust the range, come back here. Like, okay, when you find a good happy medium, you look at it and you're like, okay, this is great. I want to stake that. In addition to that, you go over here by total value. You can further fine tune. You're like, well, what would the value of my LP be at a specific price, right? At $22.50. Okay, it'd be about $46,610. So I'll be down about 2,500, almost $3,000 on this position at $22.50. Am I happy with that? If not, adjust your ranges and or adjust the size of your position. Maybe you have too much on. You see how you fine tune and adjust. You plan this out. This is all before you even stake the liquidity. Then you come here and you're like, okay. Then once you find a price range that fits, you're okay with the drawdown if price were to draw down. And you're not only that, but you have to be okay with the upside too. That's why I set my ranges that way, because my goal is to unstake this liquidity pool at 3,000. And you can see here at 3,000, my liquidity pool will be worth 53,000. So that's about that's over $4,000 of capital gains that I will earn. Okay, great. Not only that, but I'll look at the token distribution. You can look at that as well and determine, okay, at 3,000, what will be my token distribution? Okay, I will only have 4.3 Ethereum left. That's fine, great. So you're looking at it and you're like, well, why would you set your upper range at 35.05 if you're going to unstake it at 3K? That's a good question. Simply because the gains beyond 3,000 to 35.05, you can see that P&L curve just kind of flattens out, because up here you don't have a lot of Ethereum in your liquidity pool. So it's not gaining much value. Most of it is in USDT. So from 3,000 to 3,500, you're only making like an extra like $600 or $800. That's nearly a 20% move to the upside from 3,000 to 3,500 to only earn an extra $800. And then looking at it, what's the risk? If price were to go back down while I'm waiting for 3,500, well, I could lose all those capital gains. That's where you think about it. That's how you think about it. Plan it all here in Metrix Finance. It's the beauty of it, right? You get it all planned out. Then you figure out 3K, okay. And then you could go into the rebalancing, which I have other videos on Metrix Finance, how to rebalance, how to think about rebalancing. So make sure to check those out. But to keep it simple here, plan it all out right here. And then once you have it all set up on Metrix, you just go to your liquidity pool, stake it, set the ranges. Then you could use tools like Aperture Finance to rebalance it at specific price triggers that you determine using Metrix Finance. Okay, so when that's all done, you have it all set up, then you just let the market do the work. There's nothing here. This is perfect. Liquidity pool is perfect because what it does, it allows you to stay in the market and let your plan play out over time. Because it could take, what if it takes a year before this gets back to 3K? That's fine with me, because in the meantime, as a consolation prize, you got to think of it, the primary prize is the capital gains, right? The price going up, because that's where you're going to make the quickest and largest gains in a short period of time. But if that doesn't work out, if that doesn't play out in a short period of time, say it takes a year, okay, great. Well, I'm earning a 73% APR on this liquidity pool, and over the course of a year, I could make 35 grand, 36 grand in yields, while price oscillates in my range while I wait. That's the consolation prize, which is pretty good in my eyes. And then you just let the market do the work. You don't have to sit there. Nowhere in here did I pull up a price chart. I didn't draw any Fibonacci's, no trend lines. You could if you want to be more active. I'm not saying that that you're not supposed to, but you can if you want. But what I'm showing here is that you can be as passive or as active as you like to generate yields on your positions, right? As you're staying positioned in the market, you're bullish on Ethereum. This is how you do it. And permanent loss, what? No, and permanent loss means nothing. It's a perfect scenario. If your plan here was to unstake it at 3K, then who gives a shit? Had you held your entire position all the way up there? You didn't know that. Like back here, you're just like, okay, this is the profit I'm happy with. When price was down here at 2,500. Okay, if it gets up to 3K, I will be happy with that profit. That's why I set that range. That's where I will unstake my liquidity pool. That's where I collect my profit. That's what will make me happy, right? Of course, hindsight's 2020. Oh man, had I done this, people that complain and just mull over that perfect scenario, they don't know what they're doing anyways. I do this day in, day out, 24/7, 365. I let my liquidity pools work, generate yields over time, consistently. You join up, I have the tools. I can show you how to use those tools. I can show you how to generate yields consistently 24/7, 365, while staying protected in the market, while keeping risk at a minimum. And then you just sit there and enjoy the yields or the capital gains or buying the dip all at the same time while not doing much. That's why you sit there and just do it. Anyways, hopefully that's helpful. Like and subscribe, do all that jazz. Join the Discord. You really got to join up and just ask questions. You could join for free. So I will leave you with that. Have a good day. Peace out.